Welcome to The Explainer. Today, we're going to deconstruct a pretty fascinating investment model, one that totally flips the script on how we think about real estate. It's a strategy that isn't really about short-term profit, but about building a financial dynasty that lasts.
So, let me just start by asking a question, and it's a big one. What if you could build a massive, profitable real estate portfolio without borrowing a single penny? No mortgages, no loans, absolutely zero debt. That one question is the key to this entire explainer.
Now, to really get why this debt-free idea is so radical, first we have to understand how most people do it, right? We've got to look at the standard playbook for short-term rental investing. This is how the vast majority of investors are playing the game today.
For a lot of investors who live and breathe data, the whole process kicks off with this simple little rule of thumb. It's called the 6.5 rule. You take the property's purchase price, you divide it by 6.5, and that number right there, that's the absolute bare minimum in annual revenue it has to make just to be worth a second glance. And what this rule does is it creates this super rigid, really high-pressure process. First, you calculate that minimum revenue target. And why is that target so important? Well, because it's got to cover everything, especially that big old mortgage payment, plus your taxes, insurance, you name it. If your projections don't even clear that bar, the deal's dead before it even starts.
So here's the bottom line. The entire traditional way of doing things is built on one single thing: debt. The mortgage isn't just a piece of the puzzle. It is the puzzle. It dictates your revenue goals, it dictates your risk, and let's be honest, it dictates your stress level.
Okay, so now let's take that whole idea and just completely flip it on its head. We're going to look at a totally different way of thinking called the Legacy Anchor Partnership, or LAP model for short. This is what happens when you just take debt out of the equation entirely.
So how on earth does that work, right? Well, instead of going to a bank cap in hand, the whole thing is funded with 100% partner equity. That means investors pool their money together to buy the assets outright. No banks, no worrying about interest rates, and absolutely positively, no mortgages. Just think about that for a second. What's the immediate impact? By just, poof, getting rid of debt. One of these projects completely eliminated a $90,000 mortgage payment every single month. That's almost $1 million a year in costs that just disappear before you've even had a single guest walk through the door.
All right, so let's get into the nitty-gritty. Let's look at the numbers and see how this actually plays out. We're going to put the traditional model and the debt-free LSAP model right next to each other for a head-to-head comparison.
Okay, the first thing that just jumps right off the page, the most dramatic difference, is the break-even point. With the old way, you have to make a ton of money right out of the gate just to cover that monster mortgage payment. But in the LAP model, with no mortgage, the amount you need to earn just to stop losing money is, well, it's ridiculously low. How low? Well, get this. The debt-free model is projected to cover all of its yearly operating costs with just 24% occupancy. That's like what, being booked for only 12 weeks out of the entire year? Think about it. Every single dollar you make after that, for the other 76% of the year, is pure straight profit. And you can see it right here. That one single change, getting rid of debt, just cascades down and changes everything else. That minimum revenue target that puts so much pressure on the traditional guys, peak. It's not even a thing anymore. Suddenly, the road to actually making a profit is way wider, it's way clearer, and honestly, it's just a whole lot easier. But look, this model isn't just about making cash flow easier. That's just the start, really. The whole model is actually designed to solve much bigger, much longer-term problems. Things like taxes, inheritance, and how you build wealth that actually lasts for generations.
So one of the coolest tools they use is this thing called 100% bonus depreciation. Now, this is a massive tax advantage. It basically lets investors write off the entire cost of the new property in the very first year. We're talking about a huge, immediate tax savings. It's kind of like getting a giant upfront discount from the government on your investment.
And the whole thing is just built to last. It's all about a buy and hold strategy, which means you're not planning to sell, so you don't have to worry about capital gains tax. The property itself is held in an LLC, which protects it from all those messy legal fights when it gets passed down. And the way it's set up, your heirs can inherit their piece of the pie without triggering a bunch of new taxes. On top of all that, specific local laws like California's Proposition 13 can lock in super low property tax increases for the long run. And that really gets to the heart of it, the core philosophy. This is not a short-term flip. It's not about making a quick buck. The whole point is to create an asset that is designed from day one to last for over 100 years.
benefiting not just you, but your kids and their kids.
So this all leads us to this really powerful analogy, and I think it perfectly captures the totally different mindset between these two ways of investing.
Yeah, the source material had this fantastic line. It said the choice is like comparing farming for a quick annual crop versus planting an ancient redwood tree. And that just nails it, doesn't it?
So that traditional debt-heavy model, that's your annual crop. You're always chasing this year's profits. You're always worried about market swings, about interest rates going up. You're constantly at the mercy of the seasons. But the debt-free model, that's the redwood tree. It's been engineered from the very beginning for stability, for permanence, and for a kind of growth that can last for generations. So when you boil it all down, it really comes back to a simple question about what you're trying to do. What's the goal of your investment? Are you just looking for a single harvest, something for right now? Or are you trying to plant a permanent forest that's going to be standing long after you're gone? That's the choice this model really puts in front of you.